The big question I think that's going to be on everybody's mind in 2024, not just and when am I going to buy, but people that did buy over the last year that are stuck in a 9, 8, 7, maybe a 10% private money, whatever. You're stuck in a high rate and you're wondering, when am I going to refi? When does it make sense? When's the right time? Those are going to start going through your head. And that is something that we're going to talk about today on the brief. But anyways, hey everybody, welcome back to another episode, another brief with your one and only Kenny Simpson. Thanks for joining me today. Well, we are back in action. We are back on schedule, back in the office. Back from travels, back from vacation. Some of you guys might still be traveling vacation. Kudos to you, good for you. It's getting cold here in the San Diego. I look around the country, boy, it's cold everywhere. So beautiful weather out as I shoot this, nice and sunny, but freezing. So winter is here, but we got a new year. A lot of stuff going on this year, a lot of talk. What we're going to be hearing about is what people are thinking about rates and if the Fed's going to cut. Then we're going to, as soon as we get probably into the second quarter, we're going to start talking about who's going to win this presidential election, which is like, nobody wants to hear that crap, honestly. It's just going to be an interesting time. But we are here to talk about real estate, the rates, what's going on, what do we think is going to happen, what's on the docket, what are people talking about, what's the big topic. We need to start this year off. Let's start trying to figure out and mull through all this crap that's out there, all these people that talk on CNBC, on Fox, on CNN, on your local channel, that write all the blogs, all the YouTubers, or who's right, who's wrong, who's full of crap, who even knows what they're talking about. Because if we look last year, I mentioned this today, if you follow somebody, you get your information, you should go back and look to see if they even have been right or wrong, because what moves people are making and who you listen to matters. It really does. So anyways, let's jump into it. You know what we guys always talk about. Enough time jibber jabbing over here. I want to get into it and figure out what's going on with the numbers. So last week we're at 513 nationally. We got a drop. We're at 499,000 listings for the week. So numbers dropping, but usually it starts to turn back around spring. San Diego actually ticked up a little bit from 224.27 to 224.75, 273 sold, and 339 new listings. New listings are up 229%. It's funny when you hear that number, you're like, oh my gosh, we're gonna have a housing crash. Well, when the new listings went from 109 to 339, that's what happens, guys. So when you see these big numbers like percentages, you should always understand that that does not mean it's a really, really massive number. It literally went from 109 to 339. Just like when you hear the foreclosures are up 700%, it's over. When it's at zero and it goes to this number, that's what it is. So let's make sure we understand the data. We're always watching the data and not listening to people that make some off the cuss, off this. And the longer I've done this, the more I give you guys, the more I understand people that follow data that I follow, they tend to be more right because they're just tuning out the noise and following the data. Rates seem to be pretty flat from week over week. Yes, let's just backtrack, guys, because I think some people don't understand how things work. So we have a thing called, in our world, it's called overreaction. You guys ever heard of that? Like, I might overreact to an underwriter screwing up my file. Yeah, I'm just being honest. You might overreact to somebody, some shit going on in your house, whatever it is. What happened is Jerome Powell came out last year, big mouth, which I call him, and they started being all hawkish, right? And then we got some data that probably got revised and looked hawkish. We got that third quarter GDP growth, and some of this and that stuff. I don't even get into it. The 10-year treasury went to 5, a little bit over. Everybody's like, it's over. Rates went to 8, and the real estate market just went. And then basically rates at the end of the year came back down about 1.5 points, and the 10-year treasury actually touched the 3.7 something, and then leveled off around 385. And today we're sitting about 4%. But as I shoot this, I'm going on my phone right now for you guys, and I do shoot this Monday, just so you guys know. Our 10-year treasury sits at 3.996, so right under 4%. And so here's the deal. When the feds talk and we get some information, which we're going to go to, and there's an overreaction, that 10-year over goes too much. And I tell you guys this, watch the data. Don't watch the reaction. Like, it's like, who was wrong or right? Well, that guy's freaking out. Well, that guy's freaking out, but that guy was actually right. He's just pissed off about it. This person that's not freaking out is wrong. So the point is The reaction was too high. Then we got this Jerome Powell. Yes, thank you. You finally said we're probably done hiking, and then there's going to be 3 rate hike cuts. Well, what that did is sing the market going, oh my gosh, we're going to get the rate hikes and it's pivoted, it's over. And the 10-year dropped as an overreaction to the downside, which is fine, which we loved, right? Kudos to you that locked in the rates or got it, whatever. And then now we're taking back up and we're just kind of like normal. So reaction up, overreaction up, come back down quickly, overreaction down. And now we're kind of where we thought we'd be. 4.25 on the 10-year. If we go over 4.25 on the 10-year treasury, that would mean the economy's really doing something good. If we start dipping here on the 10-year and starts going to 385, 370, 360, 350, let's say that does happen, that means there's some issues going on in the economy or globally or something's going on, right, that we're not aware of. So I just want to make sure we are clear on that you're going to get these overreactions. So where we are now with the 10-year, the 380s, the 4.25 in this range, that's where we're probably going to live until we get more data. Data's coming out this week. What's coming out this week? The big thing is PPI, CPI. That is going to move. If it's good, bad, or other, that could change the 10-year treasury. So that's with mortgage rates. The last thing I'm going to mention with mortgage rates, what we're really, really hoping, please, for all of us first-time home buyers, for all of us refis, for all of us real estate investors, for anybody in commercial real estate, what we really, really want is we want things back to normal. 2024, we want things back to normal. What I want to see back to normal, I'm not worried about the 10-year treasury. I'm not worried about the job market. I'm not worried about the consumer. No. There's one thing that is screwing us right now in the real estate industry. The 30-year fixed compared to the 10-year treasury. That usually is 1.6 to 1.8. Let's just be nice and round off and say it's 2% historically. And then it did go higher last recession, the Great Recession. It changed to where we are now. That spread is about 3%. It's too high. It's too much. It needs to come down. Sure. So that just alone is going to gradually, hopefully come down this year. So what I tell people, if the 10-year treasury stays where we're at now and the interest rate, let's call it 6.75 and a 30-year fixed, the rate could be 5.75. It should be. And that's just bringing down a point. So that could just naturally happen, organically happen. Nobody manipulates that. Just the market obviously needs to feel the confidence to come back down. That is what I really want to happen this year, because if the 10-year treasury goes to 350, and all of a sudden you're talking about interest rates or, low sixes, then all of a sudden that comes down, then you're low fives. That's what a lot of people aren't talking about. So when people go, interest rates are going to stay at 6%, they might not even understand their spread. They might understand the spread could come down. So that is a factor we're going to continue to watch, but it's something you're going to hear me talk about over and over again and remind you guys. I mentioned the market data this week, CPI, PPI, yes, they're big. We'll continue to hear from Jerome Powell. You're always going to hear from other Fed officials. So there's a lot of stuff going on. The stock market had a great year last year. It's continued to rally. The consumer is still showing up. The jobs report from Friday. Well, why don't we talk about the jobs report? Because I posted this Instagram on my story today, and I was kind of like, it's so frustrating, guys. What's frustrating is, how is it that we're a government and we have all this data, and the guy that releases the data, probably hates his job, because the data he released on Friday, that number, the last 13 times it got released, 12 of them got revised to the negative. So what happens? We get this print and the market rallies and the 10-year treasury goes up, and then all of a sudden a month from now, when they revise it to 50,000 down, that does nothing. There's no way. Nobody cares. So why can't we get the data right the first time? Why would we release something that is technically wrong? I don't get it. So that's why I said that's not even correct data. And 25% of the jobs were government jobs. So here's the thing. If you really start breaking down everything, we know inflation is coming down. We know the consumer is definitely slowed down. I know that. They are not humming and hawing and hitting the gas like they were coming out of COVID. We all know that. We all know we're not doing that. They got high credit card debt. Their savings is down, and shit's still expensive, right? Inflation, but inflation's coming down. Things are coming down. It's slowly happening. The job offerings is slowing. So the job market's, slowly getting there. We do need that to get there, get more pay in the job market, but it would be nice if the data that got released was actually corrected and not revised every time to the negative, because when it's a negative, I don't know if we're really getting that love in the 10-year treasury and the moving rates. So as I mentioned before, when is the right time to refi, right? This is going to be the debate of every person, every client. And look, we're all different. we all have different thoughts, beliefs. We all have different budgets. We all have different wants and needs, but we also have different products. For example, you might have a DSCR loan or a non-QM loan, and you have a 1 year or 2 year prepaid. You're stuck or you got to pay it. You might be in a commercial loan. You're stuck or you have to refi. You might be in an FHA or VA loan where you have to wait depending on 210 days, 6 months of payments, whatever it is. Conventional loan, might be able to refi sooner. So here's what I will say about that. It's what do you want? Some people are okay. I'll save $200. That's huge. Let's do it. Some people are like $200 is not worth it. Some people want to save a point. Some people want to say I want the rate to come down 2 points or 1.5%. It doesn't matter. But what I can tell you is that you might be getting hammered by people or cards or all this stuff and people trying to sell you. But let's stop. Let's take a step back and think about if I'm going to refi, what does that look like? Well, number one, if you're going to refi, I'm just going to pick a number. Let's say the closing costs on a refi, you're going to refi a $500,000 loan. The closing costs are with no points, $5,000. I'm just picking a number, guys. It doesn't matter. That's just closing costs. That's title, escrow, lender fee, appraisal, stuff like that, right? That has nothing to do with setting up an impact account, all that. That's just pure closing costs. Let's say it costs $5,000. So if you save, $300 a month, you're going to recoup that money in 2 years. So it's worth it. Good. If you're going to save $100 a month, you're not going to recoup that for a long time. It's probably not worth it. So that's the way you look at it. Is we look at it, can you recoup the cost of what it did cost to refi to save that in 2 years? But here's the other thing is, if you know, and if you're wondering, well, Kenny, aren't rates going to come down lower this year? Yes. Are we 100% sure? No. Is that the prediction by everybody? Yes. So if I have a 8% rate and somebody's offering me 6.5%, yes, I could refinance. Yes. But also they might be calling me back and I might be refinancing again at the end of this year, next year, most likely. But yes, I would bank on it. So then I could go from 6.5 to 5.5 or 5. Correct. So is it smart to pay the fees now or wait and then pay them later? That is your decision, folks. But you got to remember, some of you might be tight on loan to value, have to come up with money, all this. Some of you are like, well, shouldn't I just wait? So if you refi now, refi later, there's a cost then, cost now. Even if people do no closing costs and do all this stuff, that's great. They're raising the rate or doing something else. You're not going to get the lowest rate with no closing cost. They're going to have to raise it a little bit to pay for the closing costs. So the point is, you have to know what's best for you. There are some people who are stuck in a prepay. Some people just cannot refinance, but you have to know what's best. Talk to your lender, talk to your banker, talk to your mortgage broker. If you need help, if you want me to look at a scenario or tell you it's very simple, we can look at it, see if it makes sense. I'm not here just to do refis. I'm here to make sure it's smart, and it's a good investment to do that. Yes, it is an investment. You're buying a home, it's an investment. You're paying down money, you're paying closing costs, you're buying something, you're investing your hard-earned money into this house, whether you live there or you rent it out, it's an investment. Because you took the money you made and invested it into a primary, invested into an investment property, invested into a 4-unit, invested into a commercial property. So if you refi, you have to maybe invest some of that equity or invest some of your money into that refi. So you want to make sure it's smart and you're getting a good ROI, return on investment. Like it makes sense and you shouldn't wait. So if somebody's sending you a mailer or calling you and pressuring you, hang up the phone immediately. Do not work with people like that. That's not the way you should be doing refi. Refi, your loan officer should be like, oh my gosh, this is a no-brainer. You might even say it's not. So whatever you're comfortable with, that's what you're comfortable with. A couple of big things going on too. Everybody's locked in, 1%, 2%, 3%, 4%. So a lot of people are, doing HELOCs or doing HELoans. So there's a HELOC, which is typically, it's like a credit card revolving line, 100,000, 200,000, 500,000. Interest rates typically prime plus 1 or prime plus something. Maybe you're lucky enough to get a HELOC a couple of years ago where you got prime plus half, prime plus, prime minus half, prime minus 1, you're looking good. You're like, shaka, woo! That's awesome. So there's HELOCs, it's interest only. You can use it, you can pay it down, and those are good products. And you can get those I can help you with those, banks, credit unions, whatever. Those are subject to different banks have different guidelines. Some will go to 80%, some will go to 90%, some will go to 70%. So you got to know where you're going, what you're doing, and you don't know where to get the best rate is. So you got to shop that around or just call, your lender, your mortgage broker, they can help you. The other thing that's popular, we're calling it a HELoan, which is a HELOC, but it's a loan. So you have to take all the money at once. It's a 30-year fixed rate. And, it's kind of like a HELOC, but you take all the money and it's a 30-year fix. Those rates are typically, probably in the 9s and 10s, maybe lower. But here's the thing is, make sure if you're getting a HELOC, if you're getting a HELoan, whatever it is, you understand, is there a little prepay? Is there a thing to get out of it? Is there an annually fee? Also with the HELOC, is there a floor rate? Here's the thing is, some of you guys are locking a HELOC at 11%. The floor rate's 11. So when they go down, it will not go down. You have to refi out of it. So you want to look at a HELOC, the floor rate's 1.99, the floor rate's 4.99, whatever it is, you want to know that, right? So those are the things that are important for you to know. HELOC, the cost, the appraisal, the LTV, the CLTV, what are the margins? What can it get to? Can it adjust down? Obviously, if you have a HELoan, you'll have an opportunity to consolidate the two and rates come down, or you'll refi that HELoan maybe when rates come down on that too as well. But all these products are helping people tap into equity, buy another home, invest the money, pay off debt, whatever it is, redo your house, whatever you need to do. Another thing I want to talk about is, how do you ask your family for money? There may be a mom or dad that's sitting here listening to this and they're going to be like, interesting. Let me tell you, I've been doing loans for 20 years, helped thousands and thousands and thousands and thousands of people, okay? I will tell you, there is definitely a way you should ask your parents for money or not. Look, some parents are voluntary and say, hey, son, if you want to buy a house, or hey, daughter, or whatever, I'll give you 100 grand, 200 grand, 500 grand, $1 million. Yes, all those have happened. Like, some folks are very lucky. They're very fortunate parents. But some parents, they're not coming to you and you're scared to ask. You're nervous. You're like, they might say, no, I don't even have the money. Some people are surprised their parents even had the money because they don't talk about money. They have that money conversation with their parents. So what I would tell you is this: if you're a first-time home buyer, or you maybe want to buy an investment property, or you want help with your parents or a partner, whatever it is, get your shit together before you go ask. Have a game plan. For example, go get pre-approved with a lender. Number one. Know your options. Number two. And number three, know what option you would pick, what's the closing costs, what's the down payment, what's the rate, what's the payment, all that stuff. Then you get back into, hey, I was looking at this house or this condo. And here's the deal. Most parents are willing to help you if they look like you have your shit together. You know the numbers, you know the costs, and you can present it to them. Then they can also get on the phone and talk to your real estate agent, talk to your lender, and have that conversation. They also, what you might be trying to sell them is, hey, I don't really want to buy a condo, I'd rather buy a house. I need a little bit more money. Or do you need down payment? Do you need them to co-sign? What is it that you need from your parents? So if you go to them with exact game plan, exact house or condo you like, with exact numbers of what it costs and what you need from them, it's very easy for them to say yay or nay. And if they say no, maybe you have to go somewhere else and you're not dead in the water. But if they're most likely going to say yes or partner with you if they realize you did all the research, all the homework, you got all the stuff down, and man, you're not just coming to them like, hey, will you help me buy a house? I don't know anything. Think about the conversation. So I will tell you, anybody looking to get money from family members, get your shit in order. Have a plan, work with a good team, your agent, your lender, so that way they can call them, they can ask questions, they can feel confident. And if they have the money and they're confident, they'll help you out. Even if they don't have that much money, sometimes they're willing to give you whatever, 5 grand, 10 grand. Maybe that's all you need. Maybe they're willing to co-sign. Maybe you have the down payment, you don't have enough income and you need them to co-sign because they have the income to help, whatever it is. And if they do co-sign for you, do not miss payments. Do not screw them over. And if you do get in financial hardship, call them up and talk to them. Do not ruin their credit. That's the worst thing you can do, and make sure you work that out. But I'll leave it at that, but hope that can answer questions. If I can help you guys out with talking to family or getting that stuff together, let me know. All right, let's go to a couple quick articles that I want to cover this week. All right, our folks at Housing Wire put out a new article, talks about a new bill in Florida looks to help cut homeowners insurance premium cost. Basically what this was saying is they're trying to come up with solutions, since a lot of insurance agents have left Florida just like they left California, or their insurance is expensive. So one of the things they're doing is saying is, the mortgage companies are, is why don't we just get enough insurance to cover whatever the mortgage would be, so if the house knocks over just the mortgage. But here's the problem is, does that even cover to rebuild the property? So the point of the story is they're trying to come up with solutions because insurance is so expensive, but it's really hard. Condos are actually, you guys might live in a condo, you don't know this, but some of these condos are actually having to become underinsured because they cannot afford how expensive the condo project is. I talked to a lender, and the gentleman runs the condo department. So he looked over all the condos, make sure they're warrantable, non-warrantable, any issues, this, that, checks insurance. He lives in San Diego. He actually lives in a condo, and he told me, Kenny, 2022 for 170 units, the condo thing we live in, it was $60,000 for insurance. I was like, okay, I don't know if that's good or bad. Okay. He goes, we went to renew that policy. I said, okay. He goes, are you sitting down? I said, yeah. He goes, it was 1.1 million. And then they shopped it around. I was like, what? So they had to go underinsured. So if something major happens, they might not have enough insurance. Wow. That is happening in certain parts of the country because of the condo collapse and all this other insurance and this and that. But California, in late September, California's top insurance regulator announced that new rules were in works to persuade insurances to remain in the state. Over the past 18 months, 7 of the 12 largest insurance companies by market share in California have either paused or restricted new policies in the state, highlighting by the departures of State Farm and Allstate in early June of 2023. The two major insurance cited the increased wildfire risk in the state and risking construction costs as the reason of their departures. So they're all trying to help get these guys back, what they can do. So I think what you're going to start seeing with insurance is government, whether it's local, federal, whatever, they're going to have to step in and start working because we need insurance. It's going to start causing more and more problems, places like California, places like, Florida and many other areas across the country, which I don't have on the top of my head, that deal with flooding, earthquakes, fires, tornadoes, all this stuff, hurricanes, right? The whole thing, because it's too often these problems are happening. The cost of construction is too much. The insurance companies it's not profitable and they cannot stay in business and do this any longer. Another article by our buddies over at Housing Wire. Older Americans could become their children's biggest expense in coming years, says aging advocate. Yes, as we all know. So right here, in 2002, adults over 65 spent $48,000 adjusted inflation a year on average, according to Data Bureau Statistics. She wrote, today it's $58,000 more than an increase. The average rent and medical costs for those living assisting stand out, $65,000. So the average somebody over 65 is spending about $60,000 to have assisted living. You might make a lot of money and go, that's nothing. To probably an average person, they're like, holy smokes, how am I going to afford that? They might have some money in retirement or pension. It's not enough. They need to save money. A lot of these people might have equity in their homes. They're doing reverse mortgages, this. But what happens if the parents have nothing and the burden becomes on and they cannot afford assisted living? They don't have equity in their home. They don't have retirement. And if burden falls on the kids, what do? Do you move your parents into your house? And if you don't want to ruin your life. No offense to parents, anybody, but sometimes you're like, I don't want my parents to live in here. It's too chaotic. So I was giving a presentation. Somebody mentioned this in the presentation, like, hey, I'm living in my house. I'm helping my parents pay rent somewhere else. I want to buy another house. I can't afford it. I was like, no, you need to sell your house here in San Diego. And why don't you go buy a 2-unit, 3-unit property, a house in the front, put your parents in the back, you're closer. You don't have to drive over there. You can help them out because he's always going over their house. He's like, oh my gosh, I never thought about that. So if you are in this predicament where you have to take care of your parents, you're thinking about it, one of the things you could do, especially in a state like California here or San Diego, I know that there's other parts, is, if you can't afford to buy another house, you might have to house hack. Yes, you might have to sell your house to support your parents as they supported you by, wiping your butt and wiping your snot nose and putting you through college and paying for your life. And now you got to pay it forward to them. You might have to temporarily go either move into one house with them, which a lot of people don't want to do, or go buy that two units where they can live in the Grandy flat, live in the ADU, or live in the units in the back. That's the whole part of the Grandy flat ADU. And you can help take care of your parents at a much favorable cost. And then if you also could just send maybe a nurse or something out to the house when you have to, instead of $65,000 a year, I'm sure you can get that number down. So house hack your way to help your parents is what I was going to get out of this article and what I would focus on. But speaking of house hacking, Zillow co-founder Spencer, let's have a listen to what he has to say about the market, what he says happening, and interesting about house hacking, maybe not what you think, buying the 2 to 4, but how people are house hacking in a different way.
Now they're 6 to 7. Redfin predicts 6.5, 6.6 by the end of the year. Realtor.com predicts low 6s by the end of the year. What we're also seeing, though, and a sign for optimism in the housing market, is more house hacking. So this is people finding creative ways to drive affordability in a world of low inventory and high rates. And one common way to do that now is through co-ownership. And so that's why Picasso, my company, is growing so quickly. We're now in 40 markets in 5 countries. We passed $1 billion of sales. Co-buying, especially in vacation destinations, is a really attractive way to house hack and get your way into a market that you might be priced out of otherwise.
When you said
there
house
are other
hack,
tactics buyers are doing, like finding alternative destinations. So Mount Rose, Nevada, for example, instead of Reno, Tahoe. Bald Island, North Carolina, instead of Kiowa, South Carolina. Golden, Colorado, instead of Vail and Aspen. So Picasso data shows a lot of these secondary markets are stealing share from these primary markets that more and more people are getting priced out of.
Yeah, affordability obviously still a very key component here. And you mentioned patience being the key that could unlock some of the freezing of the markets that you're seeing. What changes patience? I mean, we've seen 2 years of this. What ultimately, if rates are kind of near these levels for the foreseeable future, what ultimately changes the patience equation for folks that gets them kind of out of their homes and a little bit more movement on the supply front?
Well, there's a lot of psychology, obviously, in all markets, but especially in the housing market. And the more time passes, the more people are getting used to 5, 6, 7% mortgage rates. So at first, it seemed like a total sticker shock a year ago when after 5 years of 0 to 3% mortgage rates, all of a sudden we were seeing rates in the 6, 7, 8% range. Now we've had a little time to adjust. They have come down. That's starting to generate more and more interest. So I think we'll see.
Interesting, as he said, house hacking, not just, hey, I'm going to buy a house, put roommates in it, buy, to have I mentioned before, my parents come in, help them out, or my, whatever, my wife's family, my family, whatever it would be, right? But he's also talking about people that want to buy a second home, a destination property. They're not going to go to these crazy expensive markets. They're going to go to, secondary markets. They're also like Picasso. You can own a piece of a property and go there, 2 weeks out of the year, a month out of the year, whatever it is. So people are partnering up, they're house hacking, finding different ways where it's more affordable to get to, whether it's a primary or 2 to 4 or even a destination. So pretty cool how house hacking can work in many different ways for people. And finally, but not least, let's see what our local here news has to say about San Diego market.
6.5%. Now, last month, they were closer to 7%. The experts I spoke with expect they will drop even lower this year, but that doesn't mean you should wait to buy.
When it comes to buying a home, there's a lot to consider. For starters, how much will it cost to take out a loan? 2023 saw some of the highest mortgage rates in years, close to 8%, but they have since gone down and are now under 7%, the lowest level since May.
I think the outlook looks good as far as interest rates are concerned.
Alan Jin is an economics professor at the University of San Diego. He says the Federal Reserve started raising interest rates to combat inflation. As the economy improved, those rates dropped, and they're expected to be cut even further.
I think we'll probably see at least a 0.5% drop in the rate that the Federal Reserve is targeting, and that'll translate into lower mortgage rates as well.
That 0.5% could equate to a savings of hundreds of dollars a month. So does it mean you should wait to buy? I asked him.
Should you wait to buy? It's just it's whatever you're comfortable with, right, guys? This is the question. Should you wait to refi? Should you wait to buy? Here's the thing. As rates come down, affordability goes up. When affordability goes up, is there more or less buyers? You can answer that question, and you know what the answer is. There's more buyers. So as rates come down, more buyers will come off the sideline. Yeah, hopefully there's more inventory, but think about it. The best time always to buy a home is fall and winter, because that's when you get best deal. The worst time is spring and summer, because there's just a lot of traffic. Yes, there's more inventory, but you're not going to get the best deals. So when I say the worst time, I'm meaning for as far as deals. But so spring, summer is going to be very busy this year. My expectation is, but as the rates come down and affordability goes up, you're going to have a lot more buyers come off the sideline. And so when you have 10 offers on a house now, expect the 30 to 40. That's what we're expecting if we do not get the inventory. A place like San Diego, we're just not going to get the inventory. I can tell you right now, there is no way, unless we had a gnarly job recession or some major hit to the economy, which nobody's expecting. It would have to be like a COVID type moment or a pandemic or something like that. But as you know, the government came in and bailed us out then. They would probably do it again, unfortunately. But that's it. So if you're looking to buy and you're waiting, you're just going to have a longer line. You're going to have more traffic. You're probably not going to get as good a deal on the house. Rates could be lower. Affordability could be better. But you're just going to be like shopping Black Friday. Is you're going to get, maybe you're going to feel like you're getting a better deal because the rate's lower, but you're actually going to be waiting in line. And ultimately it's like, are you really getting a better deal? Who knows? Anyways, guys, that was a long one this week. I appreciate you hanging in there with me. A lot of stuff to go through, but one quick thing before I let you go, I am going to be starting a YouTube channel. There is one now where this goes on. It's actually going to be my name. It's going to be talking about a lot of the brief will be on there in a different kind of format, but it'll be talking about a lot of stuff for first time home home buyers, house hackers, VA, FHA, all that stuff, mortgage tip, home buyer tips. So when it comes out, I will let you guys know, but I will ask you guys to help me promote it and get in front of many people as possible. Because as you guys do know, I love to shoot content at this point. I love to educate, and I do educate based off data, not off hypothetical situations. So anyways, welcome back. It's a new year. Let's get after it. Everybody's back on track. If I can help you, reach out. Have a good week. Talk to you next week.